Many fund houses in India have launched quant-based and factor-based funds. However, only one fund house has chosen to position itself entirely as a quant-based fund house, and that is the relatively young NJ Asset Management Company. This fund house has been promoted by the NJ Group, the largest distributors of mutual funds in India, who have contributed about 130,000 crore worth of assets to the mutual fund industry. To understand why the fund house has chosen to take the quant route exclusively, the kind of resources and preparation they have poured into pursuing this strategy, and how quant-based funds can fit into Indian investors' existing portfolios of active and passively managed funds, we spoke to Mr. Rajiv Shastri, Director and Chief Executive Officer, NJ Asset Management Company. Do watch this interview to learn all that you would like to about quant-based investing. Good morning, Mr. Shastri, and welcome to our show.
Good morning, Sanjay. Thank you so much. It's a pleasure being here.
Our goal for this interview will be to learn from you all about factor-based investing and rule-based investing. But I would like to begin by asking you about your promoter group. The NJ Group is apparently India's largest distributor in the country. Could you tell us a little about them?
So the NJ Group's journey is a very inspiring one. If you look at, from where they started and how the evolution happened, they started off like any other corporate distributor trying to do the sales themselves. But very quickly, both the friends realized that it would be a much better way to approach the market if they were to create a platform and train other people to sell mutual funds using that platform. So in many ways, and they went about creating, a technology-enabled platform to allow distributors to sell mutual funds using the platform as well as the research that they provided. Now, in many ways, it is India's original fintech. I mean, because it provided a platform service. I mean, there are about 25,000 distributors registered on that service. Today contributing a total of more than 130,000 crores to the mutual fund industry. And a bulk of it, I think more than 90% of it is in equity funds, equity or hybrid funds. So, the idea of creating the platform, training people, and training them to do the right thing, training them to to go and how do you go and talk to investors, what is it that you tell them. So they pioneered the idea of SIPs even before the mutual fund industry started talking about SIPs. NJ India and NJ Wealth was talking about SIPs through its channel partners. They also pioneered the idea of asset allocation, on how to manage markets ups and downs, using allocation between debt and equity. So there are a lot of things that they've pioneered over the years, and what you see today is a reward of broadly three things. One is thought leadership, right, in terms of the platform that they provided, in terms of the training that they provided, in terms of the concept that they promoted. And the second is about unflinchingly doing the right thing at all points of time. So that is something that builds trust. So there are partners who've been associated with NJ Wealth for more than for almost the entire journey, for more than 20 years. The same thing is about investors. The same thing is about employees. So if you go down to Surat, you'll meet employees who've been with the group for a couple of decades, and that shows the kind of approach that they have to their own people, to investors, to the partners. So they built a lot of trust by unflinchingly, unfailingly doing the right thing year after year after year after year. And that's one of the reasons why they are where they are today.
So the right kind of selling has paid off for them, doing the right thing.
Absolutely. The right selling, as well as the right, the right approach to business, treating everybody as an equal, not trying to preach to the world, but try to train the world into doing what is, what would be the, the right thing to do.
Now, Mr. Shastri, you have chosen to be a quant-based fund house. What is the reason for this decision? Do you see a market opportunity in positioning yourself this way?
Uh, 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 well, yes, definitely there is a market opportunity to position ourselves this way. If you see what has happened in the international markets, quant-based funds, rule-based funds have emerged as a complement to active funds. It's not about competing against, the discretionary, traditional discretionary active funds that we have in India. They've done a wonderful job of creating wealth, I think, and they will, continue to do a good job of creating wealth. So it's not about competing with them or saying that we are better. All that we are saying is that this is a completely new way of doing things as far as India is concerned. It takes a different kind of approach to do this. So a traditional discretionary fund house may not be able to do it, in the way it is supposed to be done. And by positioning ourselves as as an exclusive quant house, okay, we are putting in place the resources as well as the facilities that are required to do this extremely well, and positioning it as, like I said, as a diversification opportunity as a complement to existing products. We are not saying that you should move all your money from traditional active funds to to our products. What we are saying is this is another product that is there. Since the approach is very, very different and it eliminates human bias to a very large extent, the portfolio that emerges is very different from from what you would see in a traditional discretionary active fund, and that gives you a level of diversification which you did not have till date. So an allocation to these products is something that we are advising.
So, what makes you suited to be a quant fund house, or what steps have you taken in that direction? If you could give our viewers a sense of.
Sure. So we started, with a quant-based approach when we launched our PMS in 2010. And we've been doing it since then. For 12 years, we followed a completely rule-based approach to investing. Our portfolio management service started off in 2010 with a very simple asset allocation product. But the asset allocation was based on rules. So there were rules that were followed to allocate between arbitrage and equity, or debt and equity, whatever was the whatever product was suitable from a tax perspective at that time. So we started off with a simple rule-based asset allocation product. Uh, that was our first product. As time progressed, we realized, and we were investing only in mutual fund schemes, right? So as time progressed, we developed ways to select mutual fund schemes that would do well, rather than have investors select the schemes themselves. We launched facilities where we would select the mutual fund schemes. And as time progressed and as data became available and more reliable, actually it's all about the reliability and availability of data. uh, that is when we started, launching our stock-based strategies, which is about 5 years ago. So for the last 5 years, we've been exclusively, we have our mutual fund strategies as well, but we have our stock-based strategies which have proved to be very, very successful with our investors. They've done extremely well, so we've built up the library of knowledge that is required to do it. We've learned a lot over these 5 years. We've learned what databases to trust, what not to trust, how to build our own database. So, for example, we have our own database. We do not, source our data from any one service provider. We take data from multiple service providers because there are data gaps in almost every provider's data. So we have to complete the database that we have, because that is our foundation. And so we have, we've done all of those things. We've created a database which is I honestly think is the best in the country today. We have a team that is specifically dedicated to managing the data and programming the rules that are required to analyze the data. We have a specialist team of financial technologists, people who have been in the financial markets but understand it more from a technological point of view on how to use the data to identify stocks. So we have all of these teams in place. We have database experts, programmers, financial technologists. These are the kind of skill sets that are required to to do quant investing well. And since we put in the hours, so to say, we feel that we are eminently suited for this. And to repeat what I said, we are doing only this. This is all that we know. This is all that we will do. we won't be envisaging launching, getting into traditional discretionary active management, at all. So this is all that we do, and hence we are the best suited for it, given our experience, given the efforts that we put in, and the fact that we are exclusively positioned here.
Now, how is a quant-based fund different from an active fund? I suppose even an active fund manager will start with the entire universe of stocks, then they will use some filters, reduce the number, and after that, I suppose they also do qualitative research. In the sense they go out and talk to sources. How is a quant-based approach different?
So the subjectivity, in selecting stocks is absent in quant-based products. So let me explain the quant development process, and then we can compare it to the normal traditional active management process. So the quant development process, like I said, starts with the data. You need to have high quality data to get a high quality output. You can't have it's garbage in, garbage out. So if you have garbage for data, you'll get garbage for an outcome. Then the rules that we use, the factors that we use, quant-based investing is also called factor-based investing. The idea is to identify desirable characteristics in stocks using already available data. Now, these desirable characteristics can be in the form of fundamental factors or in the form of technical factors, right? So typically the fundamental factors are value and quality. So there's enough data that is available, historical data that is available to understand whether a stock is a value stock, compared to its peers or compared to its own history, on the various parameters that we use to measure value. There is enough data to determine whether a stock is a quality stock, again, compared to its own history, compared to its peers. How does it stand? What is the consistency of its profits? What is the level of the return on capital that it's generating? Things like this. So we use very logical investment and very sound investment principles, okay, to design parameters that we can use to identify these characteristics in the stocks, right? Then based on these rules, we create a portfolio, right? And that portfolio we execute without any qualitative input, without any subjectivity. So the portfolio is executed as is. So if our protocol, which is a set of rules, throws out a set of stocks that we need to buy, we will buy those stocks, period. So that is so it cuts out human bias at that point. There's no human emotion involved in selecting those stocks. There is a lot of human effort involved in developing the rules and the protocols, right? So there may be some bias that creeps in there. Like for example, if someone is very value biased, they might give the value factor a much higher weightage as compared to the other technical factors. So there might be an element of bias at the development process, but there is no bias at the final decision making stage, right? So that is the big difference that is there between us and traditional discretionary active. I'm not saying that discretionary active fund managers do not use rules and filters. Of course they do. But at the end of the day, the decision is made by a human being, on what to buy, how much to buy. Whereas here, that what to buy and how much to buy is determined based on pre-established rules that are there.
Now, in the developed world, passive investing has become very popular. Have factor-based funds also caught on to the same degree? Are they as popular, say, in markets like the US?
So the word passive in the developed world has very different connotations than what we understand out here. In fact, there are active, index funds out there which are also classified as passive. There are active funds out there which are also classified as passive.
What does that mean?
So there are dynamically managed funds which are structured in the form of ETFs. Okay, the ETF vehicle in the developed world, specifically in the US, the ETF vehicle is very tax advantaged. The taxation treatment that we have for a normal mutual fund out here is the taxation treatment that is restricted to only an ETF in the US. In the US, a normal mutual fund has a pass-through status, which means that every element of income that it earns, whether it is dividend or short-term capital gain or long-term capital gain, is passed on in its tax treatment to the underlying investor, and the underlying investor has to pay tax according to that head of income, right? ETFs there and mutual funds in India are exempt vehicles. Okay. So what happens is at the fund level, we do not pay any tax, right? And therefore, the tax that is paid by the investor is only how they interact with the fund. So their sales and purchases of the fund, they get taxed on that, right? So ETFs have emerged as a vehicle of choice in the developed market, and that is what has seen, that is what has appeared as this, explosion in passive, because everyone thinks that ETFs are passive funds. ETFs there are not passive funds. All rule-based products, all factor-based products are structured as ETFs. In fact, a lot of active funds are structured as ETFs, right? So while we see it as the, an explosion in, in passive management, it is actually an explosion in ETFs, right? Which are being used as a vehicle to manage money, but they're not necessarily passive in nature. Now, coming to factor-based funds and rule-based funds, uh, these have been the major, growth engine for the asset management industry internationally over the last decade or so. Specifically after the global financial crisis, there was a lot of dissatisfaction that crept in with the amount of discretion that portfolio managers had, fund managers had, and there were attempts that were made to kind of rein in that discretion. And simultaneously, because factor-based research has been going on since I think the 60s, there was a very a good body of research that was there. There were practitioners and academics who were, very, very proficient in factor-based investing. That emerged simultaneously, and almost the entire growth, in fact, more than the entire growth of the asset management industry has come from factor-based products. Uh, uh, Traditional active funds have actually shrunk, and a lot of the money has gone to factor-based products. So it has contributed very, very meaningfully to the growth of the asset management business in the developed world.
Now, give us a sense of which factors are more likely to do well in India. What is your view on this? There are so many of them.
Okay, so while there are about more than 300 well-studied parameters that we can use to measure the presence of factors, there are about 5 factors which have emerged as the 5 factors under the umbrella of which 300 parameters lie. There are 5 factors which have emerged internationally as as ones that do well. Now, one of the things about factors is that if a factor, the factor performance doesn't have to be persistent across time. It has to be consistent across geographies as well. Otherwise, the underlying theoretical thesis just fails, right? If there is a particular factor that works only in one country, then that's not a genuine investment factor. That's just a technical factor that is suited to that market, right? So a genuine investment factor is something that works across the world. The parameters may differ, and the way you develop that factor may differ, but the investment thesis remains the same. So these 5 factors that have emerged globally are value, quality, momentum, low volatility, and size. Right? Size is actually it's anti-size. So basically, smaller stocks perform better than larger stocks over a longer period of time. That is one factor which India cannot take advantage of. Indians cannot take advantage of meaningfully, because there is a almost a complete lack of liquidity at beyond either the top 200, 300 stocks. So it's very difficult to take the size factor into consideration. So for our business also, for our models also, we don't take into account the size factor at all. Now, the other 4 factors, which are value, quality, momentum, and low volatility. Low volatility has actually emerged as a very good filter to cut stocks out. So if you cut out highly volatile stocks, the outcomes are much, much better on a risk-adjusted basis. Okay, that is across the world. Momentum works wonderfully across the world, where it is one of the most volatile factors. So there you see that there is a natural kind of combination. If you can use momentum and low volatility together, you can actually temper the volatility in momentum stocks, at the same time get the benefit of momentum that you can get. Similarly, with quality and value, right? There is a very significant overlap between quality and low volatility. Right? High quality stocks tend to have very stable stock prices, or not very stable, but relatively stable stock prices, right? And quality and value stocks are something that there is a narrative that is going on right now that value hasn't worked and value stocks haven't worked. But I think it's kind of a false binary that is being drawn, because the way we measure value has changed considerably, right? We've tried to do it completely in a in a simple quantitative manner, and this is something that is true for for active fund managers, discretionary active fund managers as well. They value they measure value in terms of P, PV, and price to sales, and all of those indicators. The thing is about that is that you can have very cheap stocks out there in a country like India, right? You can have very cheap stocks out there, right, which continue to remain cheap forever.
The value trap.
The value traps, right? So that is where the tweaking comes in. That is where the customization to a particular market comes in. Because if you were to go mathematically and buy the lowest PE stocks, you'll probably end up with the value traps, right? The reason why those stocks are value traps is because there are concerns with regard to the management. There are concerns with regard to. So what is the intention of buying a value stock? At the end of it, you're trying to buy something which is cheaper today in the hope that it will appreciate. But if you end up buying something that is cheap and it remains cheap, right, then you get nothing out of that exercise. So, which is why there is a narrative that builds up saying that value hasn't worked. It's not about value not having worked. It's about us being unable, a lot of people who have been using very simple rules to identify value, being unable to actually, measure value correctly. So all the four factors that I've mentioned, which work internationally, work here as well. The only thing that differs is how we use the parameter, what little bit of customization do we need. Like, for example, how do we exclude value traps? So you need to customize the rules a little so that you can suit them to a particular geography. But the concept of value will work here. It works in, it has worked everywhere and will work here as well.
You have a balanced advantage fund currently among your product offerings. And I suppose both the asset allocation and the security selection is done on a rule-based basis. Give me a sense of, I understand how the asset allocation can be rule-based. That is what all fund houses do. How will the stock selection in your case be rule-based?
Okay.
Yeah, please.
No, sure, sure. Let me attempt to explain that. But, so firstly, we have only one mutual fund product, but we have 10 portfolio management investment approaches that are there. We manage close to over 3,500 crores on the portfolio management services for more than 4,000 investors. So it's a very reasonably sized, large size portfolio management service that we also have, and we have about 5,000 crores of assets representing about 1.25 lakh investors in the mutual fund. Now, about the strategies. So there are single factor strategies and multi-factor strategies. We have single factor strategies on the portfolio management side. We have two single factor products. On the mutual fund side, we have a single product right now, which is the Balanced Advantage Fund, like you rightly said, and that follows a multi-factor approach. In a multi-factor approach, think of it in terms of when you buy a car, right? So when you buy a car, you're looking at the features that you like the best, right? Now, if you have a lot of money, you might end up buying, one car that absolutely purely represents the feature that that you like. So let's say you like speed and you like excitement, so you might end up buying a Ferrari, which is a very fast car. You like consistent quality, you like a lot of consistency in your vehicle, you might end up buying like a Japanese car, which when you get up in the morning and start the car, it'll start, right? If you want something reasonably priced, you might end up looking at a lot of the Indian brands today are offering very reasonably priced, reliable cars, but reasonably priced. They might not be the fastest on the road, they might not be built to the highest quality, but they're very reasonably priced, so that becomes attraction. So you've got these two options of either buying a car that represents a single feature, okay, or trying to combine all the features that you want and arrive at the perfect mix for you, right? So what we do is that we measure the four factors that we have. Like I said, we don't look into size at all. We look into quality, we look into value, and we look into security. right? So size is out. We are restricting ourselves to the top, end of the of market capitalization, because that is where the liquidity is, right? If you go beyond, let's say 200, 250 stocks, liquidity just disappears and you start getting trouble in execution. So we are restricting ourselves to the, the top tier of the market capitalization. So we are inherently an anti-size portfolio. Size does not play a role out here. Then what we do is that we measure individual factors, right, based on parameters that represent those factors. So we have, three factors for value, we have three factors for quality, we have two for volatility, where in the volatility, two for momentum, where in the momentum factor itself we infuse a volatility filter, right? So a total of eight factors across eight parameters across three factors. We calculate a score for all of these for all the stocks in our universe, right? Then to standardize it, we create what is called a z-score. Okay, it's a statistical standardization tool. Then we combine the z-score across the four parameters and arrive at a final, total z-score. And then we rank stocks based on that and select the top stocks, from there. So that is how our investment process works and identifies stocks. We run this exercise every quarter, right? So every quarter we get a fresh set of stocks that we need to buy. The stocks that are already there in our portfolio, we continue to hold. The stocks that are not there in the portfolio, we sell. And the new stocks that have been introduced, that is the ones that we buy. So we do this quarterly because in the implementation that we have designed, there is a reasonable amount of persistence in all of these factors. So I don't need to change them every day or every month or every week. There is a reasonable amount of persistence that is there. So we are able to rebalance the portfolio every quarter and therefore keep the churn and the costs under control as well.
What are your plans for the future? Which types of funds are you planning to add to the mutual fund portfolio?
As of now, what we are very, very focused on, managing the money that has been entrusted to us by our investors. Okay, we as you would be aware, we had a very large median NFO. We collected more than 5,000 crores, and our efforts are completely focused on doing our best to manage the money that has been entrusted to us. Obviously, there will be more products that will come, but we are not going to be a launch happy fund house. In fact, we will launch products that are very clearly differentiated. So there will be 100% equity fund at some point of time in the future, like a flexi cap kind of fund that will be 100% equity fund. We'll have an ELSS, which may and both of these will be structured very, very differently, because an ELSS comes with a 3-year lock-in. So we can take certain we can change the model to kind of represent the benefit of having some an investor staying invested for a period of 3 years. So we can change the model to that extent. So there will be different very differentiated strategies for each of the products that we launch.
Fund houses have launched both single factor and multi-factor products. Do you have plans for launching those kind of funds where the fund name carries the name of the factor, a single factor product or a multi-factor product? Are those there in the pipeline?
Well, we have nothing against the fund name carrying the name of the factor. What we do feel is that we think that the market, retail investors are not evolved enough at this point of time to bear the consequences of single factor investing. Let me give you an example. Quality has been a very consistent performer, across the world, but the last entire year, it hasn't worked. In fact, for more than a year, it hasn't worked. It has underperformed broad indices by, in double digits, right? So in these circumstances, we don't know whether a retail investor would be able to bear this consequence of having taken a decision. Are they taking that decision, thoughtfully, or are they just being driven by the name, right? That is where we, kind of tend to take a step back and say, if I call it a quality portfolio, what do people expect? We are not talking about what is part of the portfolio, but if I call it a quality portfolio, what do people expect out of it? And there would be very few investors who would say that I'd be happy with a quality portfolio that underperforms the index in double digits. So that is here. So it's a we've just started the factor investing journey. And if because we've just started the factor investing journey, there's a huge learning curve for investors to overcome. Single factor performances are very, very cyclical. Okay, factors can work in certain situations and they tend not to work in certain situations. A multi-factor approach is evens out the cyclicality of individual factors and gives more consistency, greater consistency in the delivery of returns. It may not perform the at the very top of the heap, right? But it does give a lot more consistency, which we believe is better suited to retail investors. Now, coming to other fund houses who are launching their own factor funds, most of these guys, most of the fund houses are replicating factor indexes that are already there. And that's a passive approach to factor investing. We believe very strongly that India has not reached a level of maturity as far as factor investing is concerned, where you can just take an international rule, apply it to India, and invest accordingly. I think there is a lot of customization that is there that is required in India. We spoke about one of the things, like value investing, value stock versus value trap. So that is just one of them. There are other peculiarities about the Indian market, and most of the indexes that have been launched, the factor indexes that have been launched, do not take into account those peculiarities. They've taken the international rules and applied them to Indian markets. So we think that is probably a little ahead of its time. It's probably not the right way to do things, and it may give the entire factor investing world a bad name, because there will be many times when it just won't work. So that is our concern with single factor passive stocks that exist as they do today.
So you explained the shortcoming of single factor funds, but the reality is that today both single factor and multi-factor funds are available. Now,
correct.
Suppose investors were to avoid single factor funds and go for multi-factor funds, then what would your advice be regarding, say, which combination of factors can work over the long term? What would your advice be?
So like we discussed, we've had, there are these 4 factors, which have worked internationally, do work in India, provided that enough customization, monitoring, and remediation is done on a continuous basis. So there has to be a team or at least people dedicated to managing the managing the rules. It just can't be that that you make a rule and you forget about it. That's not the way it works. So the combination of these 4 factors is expected to work in India as well. The mix between these factors, okay, is something that an investor can decide either for themselves, or they can hand over that decision to people who are doing the job of studying those factors and ascertaining what works under what market conditions. So our approach is that we give it, like I said, we have quality at 40%. With a 40% weight, we have momentum and low volatility combined at a 40% weight, and we have value at a 20% weight, because we feel that is the best combination at this point of time, right? And it's all in one product, so there is no consequence that people have to bear of of us the trading that we do every quarter. So there is no consequence that people have to bear of that. Our advice with regard to multi-factor funds is the same as it would be for any equity fund. I mean, if you are investing in an equity fund, please remember that it's an equity product, and it there will be volatility, and one has to invest long-term money in equities. One should not be looking at making a quick buck. There will be times, extended periods of time, when you will not make a buck. I mean, it's very possible that you will not make any money for extended periods of time. But in equities, you invest because when equities do make money, they make a reasonably large amount of money, which compensates for the entire period where you haven't. So these are the kind of things that we would advise people. Consider multi-factor products as complementary to existing discretionary active funds, right, who are fairly diversified as well. And consider these products as consider giving these an allocation in your portfolio. But at the same time, always remember that these are long-term products. They're not meant to be trading products. So they're long-term products, and we need to manage the invest accordingly. We need to make an allocation accordingly.
Thank you, Mr. Shastri. Factor-based investing is a relatively new concept in this country, and I'm sure that our viewers will gain a lot out of this interaction. It will help them understand this concept much better. Thank you so much, and do have a good day. Goodbye.
Thank you so much for having me here. Wish you a good day, and wish all our investors a very happy Diwali and a very happy New Year.
Same to you, sir. Thank you.